the insurance industry overview in India. So basically there are 24 insurance companies in life insurance as well as 34 in general insurance. When we are talking about the regulation, the IRDA, that is Insurance Regulatory Development Authority, was set up in 1999 by the government, as well as in 2001 the FDA was allowed to increase the number of players in the insurance sector.
Presently, 49% of FDI is allowed in the insurance sector. Now when we look at the penetration, it is only a mere 3.69%. Penetration is nothing but the share of premiums collected in terms of the GDP. So the government, in order to promote the penetration, has come up with various steps. For example, there are tax benefit for life and health insurance under section 80C and 80D, then making vehicle insurance mandatory for every vehicle, and moreover they are promoting micro insurance, especially the crop insurance, to farmers to increase this penetration. Now in the future, the insurance industry is expected to reach $280 billion US. That is, this number is to be reached by 2020. Gross direct premium for non-life insurance industry actually increased by 17.54% on a year-on-year basis in financial year 2018. Now when you look at the chart, you can see that the gross life premiums return for both life insurance as well as non-life insurance is showing a very huge potential, which is gathered by various statistical methods. Now what is the advantage for India? There is a strong demand for insurance, especially among the millennials as well as the newcomers. Population between the age group of 25 to 40 will be about 38% of the population. Then there is growing use of internet, which will definitely increase the demand by gathering more information. Now moreover, there are policy support from the government in forms of tax incentives, repeated attempts to make the sector more lucrative by increasing the FDI. Then there is the passing of insurance bill, which gives IRDA, the regulatory authority, more flexibility to frame regulations. Now there are also attractive opportunities like life insurance in low income urban areas has been seeing a very huge increase in their trend. Growth of general insurance, we can see that people are more on taking general insurance, especially with regard to home. Then there is a strong growth potential for micro insurance. We know that there are a lot of small areas to be covered under insurance in India.
So now I am going to talk about the industry life cycle. The industry life cycle consists of 4 stages. That is introduction stage, growth stage, maturity stage and declining stage. Talking about the insurance industry, it is still in introduction stage in India.
Though India has a very high population of 1.3 billion, the insurance penetration in India is 3.69%. Insurance penetration is defined as the share of premiums collected in terms of the GDP. The government paved the way for foreign direct investment in the insurance industry by setting a limit of 26% in 2001, which was then increased to 49% in 2014. The opening up of the insurance industry in 2001 has witnessed the market share of the sole life insurer, the Life Insurance Corporation of India, to decline with the advent of many private players. With government efforts and many policies rejig, it is estimated that insurance sector in India in coming year will grow. Insurance sector can leverage technology and can increase its penetration.
Five Forces is an analysis tool which uses industry forces to determine the intensity of competition and profitability in the industry. That is, higher the competition in the industry, lesser the profitability of the industry. Hence, it becomes very important for a strategist in this industry to analyze its competitive position. Now, let us try to analyze the insurance sector using Porter's forces. Coming to competitive rivalry, the industry is highly competitive in nature. Most of the companies offer similar type of products. Hence, in order to have competitive advantage, companies should have low costs, operating efficiency and excellent customer service. Threat of new entrants. It is very difficult to enter in this segment due to regulatory and capital requirements. Other financial service companies like banks, investment banking and life settlement firms are also posing a huge threat for this industry. Power of suppliers. Suppliers of capital such as reinsurers control the cost structure of external capital, which could cause difficulties with insurers to write new businesses. Also, limited supply of key professional talent and poaching away by rivals poses a threat to this industry. Power of buyers. Power of buyer is high due to many companies present in this industry. Brokers and distributors have more bargaining power as to what products to sell to the customers.
Performance indicators of the insurance industry is quite different from those indicators such as return on equity and return on investment that is used to evaluate other industries. This is due to the fact that the insurance industry collects premiums over a large period of time, and because of this we use an indicator known as return on embedded value, which captures the net present value of all the premiums collected. Embedded value is defined as the net present value of all future cash flows received by the insurance company. Since premium collection is over a large period of time, return on embedded value serves as a better performance indicator than return on equity and return on investment. The average return on embedded value for the listed life insurance companies in India is 19.3%. Now coming to the performance indicators, a critical performance indicator for the insurance industry is persistence ratio. Persistence ratio is defined as the number of policies going without being lapsed or being taken over by other competitors. Persistence ratio is calculated for 13, 37, 61 months respectively. Now, the average 61st month persistence ratio for life insurance companies currently in India is 62%. The advent of aggressive online insurance aggregators such as Policy Bazaar and ACO have made the persistence ratio of the industry to go down.
Now let's move on to the value chain analysis of insurance sector. Now value chain analysis is a process wherein the firm identifies the primary activities and the secondary activities that supports the process, and the firm also tries to analyze those processes. With the help of this analysis, they can actually reduce the cost and try to bring out some differentiation into the sector. Primary activities include product. With millennial population on rise, there is a dire need to change the product offering to attract them. There has to be minimum friction while subscribing for a policy. Companies can add value through secondary activities like making use of big data and thereby catering to customers' needs. This includes reaching the uninsured or underinsured, leveraging peer-to-peer networks, emerging solutions for shared economies, new models of holistic advice. The second activities include is sales and marketing. Most insurance companies in India rely mainly on bancassurance medium to tap customers. Agents are used to acquire new customers. In this process, there is a significant loss as commission fee constitutes about 15%. Hence, using online medium to acquire customers is essential. The third activity is distribution. Currently, paperwork in the insurance sector is more as compared to other sectors. Centralized KYC process can help to reduce the paperwork to huge extent. Underwriting. Underwriting involves measuring risk exposure and determining the premium that needs to be charged to ensure that risk. Multiple statistical based models will be used by skilled risk evaluators along with codified heuristic underwriting rules to achieve new levels of sophisticated analytics and rule-based decision system. Claims. Claim settlement is again an essential core process for insurance sector. Technologies like blockchain, IoT can help in reducing the fraudulent claims. Traditionally, insurance company pay around 65 to 75% in claims. This can be increased if operational efficiency is brought in. Customer service. Customer service include claim renewal, smooth claim settlement. As mentioned earlier, customer need a seamless and fast experience when it comes to claim settlement. Hence, startups like Acco Insurance credit the claim amount when the video of damaged part of the car is submitted to them.
I'm going to talk about the major disruptions which are currently going on in the insurance sector and which will definitely affect the insurance sector in the near future. So the major disruptions are namely artificial intelligence, big data analytics, blockchain, robotics and IoT.
Let's start with AI. Sales and marketing and underwriting functions are widely facilitated by the selection of coverage based on individual needs. Artificial intelligence could ease the insurance purchase process, for example, through a digital advisor. Artificial intelligence is also used to automatically process images, assess different types of damage, and calculate the extent of damage, greatly enhancing the customer experience of insurance. Chatbots. Chatbots can handle customer typed or spoken concerns and provide customized services. Chatbots can be used to answer basic questions, solve claims, and sell products, address leads, or ensure that customers are adequately covered by their insurance. Blockchain. Fraud costs organizations around the world 3.7 trillion a year, or 5% of the gross world product. According to one statistics, it will help in underwriting functions to create new business models based on customized real-time risk assessment rather than the historical data and average pricing which were earlier used. Robotics. Robotics are automating underwriting processes, settlements of claims, etc. Some firms embrace robotics in their claim management process to help them predict the possible outcome of the claims process and suggest the most appropriate strategy based on that prediction. The uses of drones are also being used. For example, claim adjusters gain useful insight through the processing of claims, in particular improved disaster claim management. Subscribers can make more tailor-made pricing that enables accurate risk assessment.
So I'm going to talk about the implementation of blockchain in insurance industry. Etherisk. Etherisk is one of the world's leading platforms to provide decentralized insurance at safe, transparent and cheaper rates. How it is doing that? It is using the blockchain technology with the internet to reach out to the mass market and cut down on intermediaries to provide insurance to the people at cheap, safe and transparent rates. Etherisk has tried to automate as much as possible the entire process of insurance claims settlement. In this way, it is cutting down on intermediaries. There are three parties mainly involved in Etherisk business model. One is insured person who buy the insurance. Another is sovereign workers, which are the employees of Etherisk, which maintain the ecosystem and develop insurance products. Other are sovereign investors who are investing in risk-based securities. Let us see an example of flight delay insurance to see how Etherisk is helping the insurance industry. First of all, a person buys the insurance alongside the ticket. Once the flight has been delayed, he files the claim with the company. A physical member then verifies this claim and settles the insurance claim via a check. If all of this process is automated, then the middleman work will be reduced. Once the flight has been delayed, this is entered into the database. The system automatically checks all the people who are insured against the flight and directly pay the amount of premium or insurance money into their bank account. This way, it is significantly decreasing the cost of insurance settlement as well as involvement of middlemen, thereby increasing the transparency in the system.